To determine whether there is an arbitrage opportunity, I compare the theoretical future value FV with the actual market future price AAP. First, I calculate the actual number of days. July 30 days, August 31 days, September 50 days. Total day is 77 depending inclusive counting used in solution. I calculate FV using FV equal to S 1 plus R times T over 365 plus storage cost, where S equal to RM 4200, R equal to 5%, T equal to 77 days, storage equal to RM 6 times 12 months, equivalent adjustment. So FV equal to RM 4200, 1 plus 5% times 77 over 365 plus RM 6 times 12 times 77 over 365. So FV I get RM 4250x.72. FV equal to RM 425x.72. AP FCPO price equal to RM 42x0. Since the market price is the higher than the theoretical value, the future contract is overpriced. Therefore, an arbitrage opportunity exists. For the two Roman, to exploit the mispricing, I use a cash and carry arbitrage strategy because the future price is higher than FV. First is buy physical CPO in cash market, sell FCPO future contract. I calculate the contract size. Total is 10k tons. One contract is equal to 25 tons. So number of contract is equal to 10k over 25 equal to 400 contract. At the time T0 equal to today, I will borrow money at 5% interest. Buy 10k tons of CPO at RM 4200. Store the CPO. Short sell 400 FCPO contract at RM 4280. I hold the physical CPO at pay storage cost until expiry. The strategy locks in a risk-free arbitrage profit by buying low in the physical market and selling high in the future market. The total revenue from selling the future contract is 42,800,000, while the total cost include the purchase of physical CPO, interest cost and storage cost, which sum up to RM 42,594 and 904.11. Therefore, the arbitrage profit is 42,800 minus which RM 42,594 and 904.11, which equal to RM 205,095.89. This represents a risk-free profit gained from exploiting the mispricing between the physical and future market. For 1B, the spread strategy in FCPO involves taking opposite position in two related contracts to profit the price difference between them. It focuses on capitalizing on relative price movement between contracts and is generally used as a hedging strategy with lower risk exposure. On the other hand, arbitrage strategy involves exploiting price efficiency between different market contract type of general risk-free profit. It's required buying and selling in different markets and often involve large capital and fast execution. In conclusion, spread trading focuses on price difference within related contract, whereas arbitrage focuses on mispricing across market to earn risk-free return. To construct the market-to-market MTM position, I calculate the daily profit and loss of a long future position and update the margin account accordingly. I am long FKB3 contract at an initial price of 97.52 with an initial margin of 60,000. Since this is a long position, I gain when the price increase and loss when the price decrease. The daily profit or loss calculate using the formula current price minus previous price multiplied by contract size and number of contract. Each day profit and loss then added or deduct from the margin account. If the margin fall below the required maintenance level, a margin call will be triggered based on the MTM table. The position experience both gain and losses depending on daily price movement, and overall it result in a total profit of 30,250. This show that future positions are revalue daily and margin balance continuous change according to market price movement. For question 2, for 2 Roman, to calculate the total profit or loss when the position is closed on 24 May, I sum all the daily mark-to-market value. The calculation is minus 2,250 plus 3,250 minus 2,750 minus 1,500 plus 60,500, which give a total profit of 30,250. This means that although there were both gain and losses during holding period, the overall position result in a net profit. Therefore, the trader makes a total profit of RM 3,250 from closing the future position. To determine the leverage effect, I compare the percentage change in the future price with the percentage return on investment. First, the percentage change in price is calculated as 97.45 minus 97.52 divided by 97.52 multiplied by 100, which equal negative 0.07%. This show a very small movement in price. However, the percentage return based on margin is calculated as 58,250 minus 60,000 divided by 60,000 multiplied by 100, which equal to negative 2.92%. This shows that a small change in price result in a much larger percentage change in return. This happened because future trading use leverage where only a small margin is required to control a large contract value. Therefore, a leverage implies both gain and losses in the future trading. For question 2b, there is an investment relationship between interest rate and bond price. When interest rate increase, bond price decrease, and when interest rate decrease, bond price increase. This happens because bond price are determined by the present value of future cash flow, and high interest rate increase the discount rate, reducing the present value of bond. Conversely, lower interest rate reduce the discount rate, increase bond price. Therefore, if interest rates are expected to fall in the future, a trader should take a long position in bond future because bond price will rise, allowing the trader to make a profit.
For question 3, AI, the suitable position is a short hedge using September FKLI future contracts. This is because the portfolio manager is worried that the stock market will decline in the short term due to depreciation of the Malaysian ringgit. So the portfolio needs protection against falling share price. Since the portfolio value is RM20 million, the manager only wants to protect 90% of it. The hedge ratio is used 0.9. The portfolio is also 65% more volatile than the market. So the beta is 1.65. To calculate the number of future contracts, we use the formula portfolio value multiplied by hedge ratio and beta, then divided by the future price multiplied by the contract size. Therefore, the calculation is RM20 million multiplied by 0.9 multiplied by 1.65 divided by 1533 multiplied by RM50, which give 387.84 contracts. Since future contract must be in whole numbers, the manager should set approximately 387 September FKLI future contracts to hedge the portfolio against a possible fall in the market. For question 3A2, the strategy is to use a short hedge by selling 387 September FKI future contract at 1,533 points. This is done because the manager expects the market to fall and wants to protect the 20 million portfolio. Later, when the future price falls by 50 points to 1,483 and coverages with the cash market, the cash portfolio value decreased because the market has declined. In the cash market, the loss is RM 1,138,671.88. So the portfolio value falls from 20 million to 80,861,328.12. However, the future position makes a profit because the manager sold at 1,533 points and brought back at 1,483. The future profit is 967,500. After adding this profit to the reduced portfolio value, the final hedge portfolio value become RM 90,828,828.12. Overall, the hedge reduced the loss and helped protect the portfolio from failing the market. For question 3A3, the hedging result shows that the hedging strategy is effective because the hedge value is higher than the unhedged value. Without hedging, the portfolio falls to RM 80,861,328.12. However, after using the short FKI future hedge, the final value become higher, RM 90,828,828.12. This means that the profit from the future market helped reduce the loss in the cash market. Overall, the hedge achieved its objective because it protects the most of the portfolio value from the market decline. Therefore, the short hedge is suitable and beneficial. The suitable strategy is a long hedge because the insurance provider plans to invest RM 10 million later in July and is worried that the market price will increase if cash index rises. The cost of buying share will become higher. Therefore, the company should buy July FKI future now to protect itself from the increase in the purchase cost. The company should buy approximately 130 July FKI future contract at 1,533 points. Later, both the cash index and the future price converges at 1,600 points. In the cash market, the purchase cost increased by RM 666,666.67, making the unhedged cost to RM 10,666,666.67. However, the future position give a profit of RM 435,500 because the company bought at 1,533 and sold at 1,600. Overall, this profit helped offset the higher purchase cost, so the long hedge is suitable and beneficial. Next question, the suitable strategy is a short hedge because the insurance provider expect to sell share worth RM 10 million in the July and is worried that the market price will fall. If the cash index decreases, the selling revenue will become lower. Therefore, the company should sell July FKI future to protect itself from the falling prices. The company should sell about 130 July FKI future contract at 1,533 points. Later, both the cash index and the future price converge at 1,450 points. In the cash market, the selling revenue falls by 333,333.33, making the unhedged value RM 9,666,666.67. However, the future position give a profit of RM 539,500 because the company sold at 1,533 and bought back at 1,450. Overall, the short hedge is effective because it reduces the loss and increases the final hedge.
Okay, so my name is Muhammad Nabil Haras bin Muhammad Najib. I want to explain question 4, 1 and 2. So the question 1 asks to explain the type of spread trade the analysis plan to execute based on the information given above and its benefit. So I choose calendar spread. Bullish market because of decline in interest rate and price is expected to advance long near and far short. For the benefit is type spread is offering lower risk to profit rising start price (ST price). So let's continue to question 2. The question 2 is discuss of the trading strategy that the analysis will take from the expectation and interpretation. So first thing first, we must to do the table which is still in the calendar spread TS. So for December FMGS, in this table has December FMGS 2024, March FMGS 2025, and the spread. For the T0 has long 6 108.44 and for at March FMG at 2025 has the short seek, which is 108.24, and the spread 0.2. For the T1 December FMGS 2024 short seeks 108.60. For the March FMGS 2025 long 108.86, and the spread negative 0.26. For the profit, December FMGS 2024 have 0.16, March FMGS 2025 negative 0.62, and for the spread negative 0.46. For calculate the net loss, we take a spread, which is the total of spread, negative 0.46%, times with the 6 times 100 times 10, closer the bracket, and minus 50, open the bracket, minus 50 times 60, and closer the bracket, and get the answer is negative 3060. So yeah, okay, let's continue to the question for 3. For the question for 3, the question asks to determine the spread profit or loss if the commission charge are 50 per contract, 50 ringgit per contract. So we must do a table in this question, and in this table has December 2024, March 2025, and the basic spread. For the T0, we must buy December MGS 108.44, and for the March 2025 sell March MGS 108.24, and we get it 20 basis points. For the T1, sell December MGS 108.60, and March 2025 by March MGS 108.86, and we get it negative to 26 basis points. For the profit or loss, 108.60 minus 108.44, we get it negative 0.16, and March 2025 108.24 minus 108.86, we get it negative 0.62. To get the net change in the basic spread, so we must follow the formula closing minus the opening spread. So for the closing, negative 26 basis point minus 20 basis point, and we get it negative 0.46 basis point. So let's go through the spread profit or loss if the commission charge are 50 ringgit per contract. So gross profit or loss, December 2024 contract profit 6.16 times 1,000 times 6 contract, and we get it 960. And March 2025 contract loss negative 0.62 times 1,000 times 6 contract, and we get it negative 3720. For the total gross trading loss, 960 minus 3720, and we get it negative 2760. For the total commission, 12 contract times 50 ringgit, and we get it 600. Net spread or loss, net position gross. The formula is net position is gross loss minus commission charge. So the negative 2760 minus 600, and we get it negative 3360. Yeah. How to get the net change in the basic spread. So we must follow the formula closing minus the opening spread. So for the closing, negative 26 basis point, minus 20 basis point, and we get it negative 0.46 basis point. So let's go through the spread profit or loss if the commission charge are 50 ringgit per contract. So gross profit or loss, December 2024 contract profit 6.16 times 1. Okay, let's continue to the question for 3. For the question for 3, the question asks to determine the spread profit or loss if the commission charge are 50 per contract, 50 ringgit per contract. So we must do a table in this question, and in this table has December 2024, March 2025, and the basic spread. For the T0, we must buy December MGS 108.44, and for the March 2025, sell March MGS 108.24, and we get it 20 basis points. For the T1, sell December MGS 108.60 and March 2025 by March MGS 108.86, and we get it negative to 26 basis point. For the profit or loss 100. Okay, so I want to explain about the question 4B. For the question 4B, the question asks to discuss the rationale behind the introduction of MGS future. So look at this, have the 5 mark. How to answer it? Have to answer, which is for the first point, MGS future allow investor and fund manager to hedge against IR fluctuation, reducing portfolio risk. For the second point is create market liquidity for the trading of the bond by providing investor accessibility and out of the market. Yeah, thank you.
Next, we go to the question 5. Before that, let me introduce my name. My name is Muhammad Izzat Izwan. So, for the question 5A, a trader believes that currently the stock market is moderate bullish and he wishes to take this opportunity to make profit by participating in spread strategy. These are two options of his selection. First, a call option with exercise price 11 ringgit, which cost him 70 cents, and the second one is call option with exercise price 11 ringgit and it cost him 1 ringgit Malaysia. For the name strategy, so for the question 1 is name the strategy. So the answer is bullish call strategy because we expect the price will increase in the future. So the question number 2 illustrate the payoff diagram of this strategy that showing its maximum profit and loss as well as break-even price. So for the first one, we need to know that which one is the short and long for the call option. So we take the short option is the exercise price with the highest. So we take 13 ringgit Malaysia is a short call option. So for the maximum profit, the formula is difference in exercise price minus with difference in premium price. So 13 minus 11 and 1 ringgit minus 70 cents. So we get 2 ringgit minus 30 cents. So we will get RM 1 ringgit 70 cents for the maximum profit. For the maximum loss, the formula is premium long call minus with the premium short call. So we get the maximum loss is 30 cents. For the break-even price, we need to take the exercise long call minus plus with the maximum profit. So we will get the break-even price is 11.30 cents. So as shown in the payoff diagram, losses are limited to RM 0.3 cents before the stock reached 11.30 cents. After that, profit increased until it reached the maximum profit of RM 1 ringgit 70 cents and at RM 13 where it remained constant. So that's all. Next, we go to the question A Roman 3. Construct the payoff table for strategy if the stock price are as follows below. So we need to calculate the long call and short call for each price. So for the long call, formula is current price minus with exercise price minus with premium price. For the short call, exercise price minus with current market price plus premium price. So as for current market price RM 10 ringgit point 20 cents, the long call we will get 1 ringgit 18, but for the premium we only can afford 1 ringgit, so we take the 1 ringgit only for the answer. For the short call we will get 1 ringgit 70 cent for the short call, but the premium only we can pay is 70 cents, so we take 70 cent put in the answer. So we go to the bull call spread, we will get minus 30 cents for the 10 ringgit 20 cents. For 11 ringgit we'll also get minus 30 cents. For 11 ringgit 30 cents we will get bull call spread as a 0. For the 11 ringgit 50 cents we will get bull call spread as a 20 cents. For 12.50 cents we will get bull call spread as 1.20 cents. For 13 ringgit Malaysia we will get bull call spread as 1 ringgit 70 cents for the answer. So next next question, if the market suddenly become very volatile and jumpy, propose the most appropriate strategy to the trader and justify your answer. For this answer, I will choose a long trader strategy instead. This strategy involves buying both a call option and put option with the same strike price and expiry date. It allows investors to profit from large price premium movement, and also regardless of whether the market move upward or downward. Therefore, compared to a bullish call spread, a long straddle is more suitable in highly volatile market condition because it benefits from significant price swing in either direction. For question 5B, Sohana bought a 1-month call option at RM 0.50 cents. The exercise price of the option is 9 ringgit 50 cents. For B Roman 1, say that after 1 month, the current market of the stock has shifted to 10 ringgit Malaysia 80 cents. Determine whether she should exercise the option or not and find her profit or loss. So we know that he bought a long call option because bought equal to long call option. So we need to calculate their pair off. So for the formula is current market price minus with exercise price minus with premium price. Yes. So 10 ringgit 80 cents minus with 9.50 cents minus with 50 cents, we will get 80 cents for the maximum pair off. So we will get maximum profits is unlimited, by maximum loss is 0.50 cents as the premium. So for the break even, we need to check the break even. So break even will take the price 9 ringgit 50 cents plus 0.50 cents, will get 10 ringgit. So the current market price is higher than the break even. So which that means at 10 ringgit 80 cents is higher than 10 ringgit. So Shohana should exercise the option because of the current market price is above the break-even price. For question 5B, Roman 2, say that instead of buying call option, she bought a put option with the same premium and exercise price. If after 1 month the share price is RM 10 ringgit 80 cents, identify whether she should exercise the option or not and find her profit or loss. So Sohana choose long put option. So for the formula to calculate the profit, exercise price minus with current market price minus with premium price. So in this answer, we will get negative 1 ringgit 80 cents for his pair off. So for the maximum profit is unlimited, but for the maximum loss only 50 cents. So for the break even we will calculate exercise price minus with premium price. So 9 ringgit 50 cents minus with 50 cents, we will get 9 ringgit. So the current market price is higher than break-even market price. So 10 ringgit 11 cents, 10 ringgit 80 cents is higher than 9 ringgit. So Sohana should not exercise because she could lose more than 9 ringgit.